It's not like a scary start, but it's a weak start, given that we've had uh, we've had very little support coming from global cues, given that the virus globally is still spreading, and the numbers where they matter, which is US and New York and the financial district, it's not a panic mode, but yeah, the numbers are now increasing at a very large alarmistic rate, so to speak. So what is the right way of looking at markets? Markets, we always say that they are a forward-looking mechanism, which is that markets will always act, react, and adjust ahead of the actual occurrence. We know the economy has taken a hit, but have markets really factored in worst of the pessimistic scenarios? And is it a good time to construct portfolio, or one should be a bit wary because these are extraordinary circumstances? One should protect capital rather than conceiving the idea of investing in this kind of a market. Vetri, a simple and a straightforward question. Are we in a prolonged bear market for equities, or do you think now we are nearing the end of the tunnel?
Yeah, hi Nikunj. Two ways to really crunch this. One is, where are we in terms of valuations? I think the answer on that, when we look at multiple indicators, is that clearly it's dropped into attractive territory. Uh, but if I were to look, let's say, at some of the lows that we have seen for valuation in 2008, 2009, 2003, then it's not very clear to me that we've gone to lows close to that as yet. So I would essentially, as an equity investor, say the markets are clearly attractive from a long-term point of view, but it's still an evolving situation. So you need to keep some of your powder dry, and that's the way I would approach it.
When you say markets are looking attractive, this is based on historical parameters where interest rates were playing a role, where situations were very, very different. Right now we are staring at a world, and I'm not talking about the medical emergency here, I'm talking about the unprecedented times we are in, where central bankers are printing money, interest rates are coming down. In US, interest rates are zero. Japan has been following a different kind of an interest rate regime. So do you think it would be a wise idea to look at historical benchmarking while judging what is coming next?
I would pretty much do that, Nikunj, because I think the best measure we have over time is the valuation cycle. It picks up how people get either excessively optimistic or pessimistic at different points of time. And when those measures start to get into that green territory, I think one has to react to that. Now, as I said, you can choose whether you want to be all in, you want to be partly in, and the market's not gone to all-time low valuations as yet. As far as interest rates are concerned, I think that's slightly more tricky territory. Remember, Japan has had record low interest rates for a long time. It hasn't done anything for the stock market. Most people, of course, point to the US example, which, low interest rates did tremendously well for the stock market. But it's only an enabling factor. It's not a factor which makes that outcome certainty. So I think that's something you need to keep in mind when you anchor to interest rates. I think from India's point of view, what really becomes interesting is that our macro situation, other than COVID-19, is actually still quite stable. The only parameter which obviously we will have to worry about in the next quarter or two will be that of growth. But I think there is enough ammunition both in monetary policy and in fiscal policy to support the economy through this difficult time.
Okay. Vetri, sir, can I safely say that all eyes are now on the government action for a relief bailout for corporates, because they've done whatever they could do to bail out and help the poorest of the poor? Reserve Bank of India, some would say they've fired a bazooka. I would say that they've used heavy artillery, but Reserve Bank of India has done their bit. So do you think now the logical extension is that a large, big relief package for industries and for affected sectors should come?
Absolutely, Nikunj. I think you hit the nail on the head. I think as far as fiscal policy is concerned, the first response from the government, as it should be, was essentially to address the humanitarian crisis. There may be more they'll have to do on that front as well. But at some point, you'll have to start thinking about what happens after we get through this successfully, let's say over 2 months, 3 months, 4 months, what comes next. economic activity would have come down. There would be stresses within the system. And I think it will be incumbent upon government to use fiscal policy at that point of time as a tool to get business activity to pick up, and government might have to make direct interventions. That you may have to also frame sector level policies. But I think this is a very classical Keynesian situation where when households and corporates are both going into risk averse mode, the fisc needs to step up. Typically we've always worried about government of India's fiscal deficit being very large. But today we are in an environment where most probably the claim on savings coming from households and corporates is going to be very, very weak. So this is the time for government to step forward and think about how it can use its spending power and sector level policies to sort of get economic activity to pick up once we get out of the short-term rut.
Sure. Vetri, on the same subject, if you had to hand out your wish list or list of recommendations to the government at this juncture, what are the 3 top points that you think the government must, execute right away to try and lift up India Inc.?
I think it's still an evolving target. And I think in that sense, perhaps, I think the Indian government's response, and as we've been hearing from Delhi, has been one more of taking gradual and incremental steps rather than trying to fire everything with the fiscal policy at one go. I think that's the right way. And therefore, I don't really want to rush out there and put forth my wish list. But I think the essential point to keep in mind is that the economy will need support. You need to be able to revise those sector level policies. I'm sure industry captains, CII, FICCI, all of them will be able to collate that and put it together. I think the main recommendation I would give the government is this is no longer a time to, focus excessively on the fiscal deficit. It's important to focus on the fiscal deficit when there is demand for money and investment from other constituents of the economy. Today, there is no demand, so this is not a time to be shy about using the fiscal deficit as a tool to get out of this slowdown that we are likely to experience. So I think that would be my primary recommendation. I think as far as the other stuff is concerned, the industry bodies will do a better job of collating what support it needs. Areas like travel, hospitality, etc., might need a completely separate sector level package. But as I said, I think that's for the industry bodies to come up with that.
Vetri, on the subject of market recovery, I know you were just telling Nikunj that we've not really hit the all-time valuations if you were to historically, even draw a comparison. But when the recovery does kick in, do you think it would be very large cap specific, or would you see a more broad-based recovery? Because in this fall, just about everything has fallen down.
So if you go back and look at history, then, most of that suggests that, from those kind of crisis lows, it's always been the sort of large caps which first lead the recovery. And it's only after that, the rest of the market starts to broad base and participate. So that is certainly something which is there in history. I would also, look at it from this point of view that I think what becomes very essential when you're looking at companies, more than just the large cap, mid cap breakup, is really to think about which are those companies which are likely to come through this challenging period relatively unscathed, because potentially they will be the companies who are best placed to capitalize on growth ahead as and when things start to normalize. And I also had one more point. I see too much simple interpretation of good for this sector, difficult for another sector. What I would essentially point to is that keep in mind that in some sectors, there could be supply side damage. And when the supply side damage happens, the survivors in those industries actually come out much stronger. So I would, be a little bit more judicious in my sense of choosing stocks rather than focusing excessively on sectors or even on large cap versus mid cap.
Vetri, how does one assess the entire space where NPAs could be a genuine problem, whether it is a tourism sector or perhaps some SME pockets or perhaps hospitality sector or food industry or restaurants? the government may have given them a 3-month moratorium, but 3-month moratorium is like kicking the can down the road. In next 3 months, nothing's going to change for them, which means after 3 months, NPAs will start kicking in. If that is the underlying situation, what happens to banks? Are we staring at a renewed, painful re-emergence of an NPA cycle for next couple of quarters?
That's a very valid point, Nikunj, and I think that goes back to what I said earlier. I think, what the government seems to be doing is more in terms of, okay, let's decide what's essential for the next 3 months, and then we can continue to build on that. I think, as we emerge from this situation, hopefully over the next few months, there will be further course corrections that government might have to take, either in terms of, widening the debt framework, lengthening the period of it, and these sector-specific interventions. So I think at this point of time, one needs to presume that policymakers in Delhi, at Mint Street, RBI, will continue to intervene as and when required, as we saw them acting last week. And therefore, I wouldn't palpitate too much about it. But yes, certainly financial institutions and banks, to the extent that these are leveraged businesses, will tend to be a lot more volatile, in my opinion, over the next few months, simply because as leveraged businesses facing these challenges that their borrowers are, you will tend to see them, face a lot more stress. But I do think eventually policymakers will intervene and address many of these.
So whenever markets will settle, Vetri, what should one focus on? Should one focus on the classics, which is great value stocks, strong dividend yield, low on price to book and strong and low on P, or should one stick to stocks or companies where we know that disruption is temporary and growth is permanent, which is something like, let's say, consumer names, FMCG names. We may be all working from home, but we're still, consuming essentials and necessities. We may not be consuming luxuries, but we're still consuming necessities.
I think, Nikunj, that's a very limiting framework, because, we're not just looking at who will do better in the next 2 to 3 quarters relative to other businesses. We are essentially buying businesses for 10 years and 20 years. And if, 1 or 2 quarters for those companies are difficult, when you look at the overall valuation paradigm, yes, it will be painful and challenging, but doesn't really change the long-term argument. So I would not focus so much on these aspects. I think, honestly, and it's always been my investment approach, to sort of maintain a balance of companies where you think the valuations are attractive, but equally you want to have exposure to companies which have long growth runway. So I prefer a lot more of a balanced approach. To my mind, the key is essentially this: who are those companies that can emerge from this challenging time and grow faster? Secondly, which are the industries which are likely to see significant supply side disruptions? I don't mind going into them if the companies are likely to gain market share coming out of this challenging period. So to my mind, there are opportunities on both sides. This is a market where, after this correction, as you mentioned earlier, many names are looking attractive. So, you don't really have to be choosy. Pick your spot and stick with it. To my mind, that's far more important. And put your feet in to the water and start buying something. I don't think you need to fixate so much about should it be A kind of companies or B kind of companies.
Sure. But Vetri, what are we staring at in terms of earnings? I know it's still early days. We don't know, most of the corporates that we've been speaking with as well really don't have any visibility. But have we got pegged back for 2 quarters, 3 quarters when it comes to an earnings revival? What is the worst case scenario that you think the market is building in or pricing in right now?
So, honestly, at times like this, the best thing to do is look at the trailing earnings and the trailing multiple rather than focus on 21. My sense is that 21 is now pretty much going to be, wash out. It will be a negative year for earnings growth. So don't fixate too much on what 21 will be. But, if you get a big negative year in 21 because of whatever's happening now, then you will also get a recovery going into 22. So this is not a time to fixate on what that exact EPS integer will be. The trailing earnings are telling you that we have dropped into reasonably attractive valuations. And when you think about companies which in the last 10 years have already demonstrated their ability to compound earnings at 12% or 15% or even 10% and 25%, what you need to do is evaluate their trailing valuations today to what could be the outcome for these companies if the next 10 year of earnings growth looks pretty much like what they did in the previous 10 years. So that's our role as stock pickers. That's our investment process. And that's what we are guided by. We are not so focused on what will happen to that 21 earnings. Yes, if the next 10 years look dramatically different compared to the previous 10 years, because let's say this virus were to, shut the world economy down and dramatically damage it for the next 1, 2, 3, 4, 5 years, that's not baked into the process we are looking at. The simple thing that we are looking at is what stocks look sensibly valued. If their next 10-year outcomes look reasonably similar to what they delivered in the previous 10, then those are the stocks we'd be attracted towards.
Okay, Vetri, we'll leave it at that. Forgot to ask, how's the lockdown treating you? It's a new normal, new way of living that all of us are going through.
Yeah, I mean, it's been tough so far. We also had a family member return from the US, so we've all been self-isolating at home, but looking forward to the end of that in 3 days.
Okay, good luck with that. Good having you on the show, Vetri. Thanks as always for taking the time out and joining in.